So now it's my pleasure to introduce our keynote speaker, Chris Cooley. Chris is the managing director of Stevens. He covers both the medical device and the hospital supply sector. Chris has over 25 years of experience in healthcare, but he looks exactly the same since the first day I've met him. He began his career with Dean Witter. Chris has been recognized by Wall Street Journal, Financial Times, and Star Mine as #1 for stock selection and earnings estimate accuracy. Chris follows all major industries, but he's been in our ophthalmic industry for over 20 years. And he has spoken at many of these type of meetings. And for people that were with me at AMO know Chris very well, because Chris covered me at AMO. And I always would call Chris Columbo. For those at AMO know what I'm talking about. You know, you get to have the analysts ask you questions, and before you go on to the next one, Chris would always say, "Jim, just one more question." And I knew that was going to be the toughest question. So it's an honor to have Chris Cooley. And Chris, please come up, and thank you for coming and taking your time. Chris Cooley.
Well, good afternoon, everyone, and thank you, Jim and Eric. Columbo. I don't know, Jim. I always saw myself as more like a Robert Conrad type of guy, but we'll talk about that. We'll maybe talk about that afterwards. Let me just echo my thanks for the Eyecelerator Planning Committee, as well as the AAO and the ASCRS for taking this bold step to have an in-person meeting. We need this type of face-to-face collaboration, and it's great to be a part of it. And I appreciate you allowing me to have a few moments with you today to talk about the financial markets. So if I could go forward. I can't see it here, I'm sorry. Oh, it's up there. So just briefly, if we could start here today, 2020 was unprecedented in all of our lifetimes. But the markets today, with actual all-time highs, present their own unique sets of challenges and opportunities. But if I can impart one thing to you today, it's that despite the increased incidence of COVID variances and the first real inflationary fears that we've seen in about 15 years, there still exists today a favorable environment to invest in growth and innovation. And that's across all of the spectrum, not only late stage and well-established corporate entities, but also in early stage and venture opportunities as well. And so before we get too far along, let's think a little bit here about from whence we came. How did we arrive at where we are today? And we all know that in the first quarter of last year, the COVID-19 pandemic wreaked havoc in the financial markets. And in fact, we hit a 30% decline at the trough of the 1st of March. Yet it's important to keep perspective in mind here, because even in the face of this decline, there was discussion of a V-shaped recovery. And that was the correct vantage point, as since the trough in March of last year, the markets have subsequently rallied approximately 100%. I don't know about you all, but I like this chart a lot better than the former one. It makes my life a bit easier. And similarly, while we were all on Zoom having our virtual cocktail hours talking about the transition from the shared economy to the virtual economy, the healthcare industry at large was doing extremely well. In fact, it was rallying in step with the broad market actually outpacing that slightly. So the obvious question then is, where do we go from here with the market at all-time highs? And hopefully what I can help you address with that conundrum is basically focusing on some key macroeconomic data and also some secular themes that we've seen across the venture capital, private equity, and public equity markets. Let's start with two very simple but very important data points. I know this is risky, so just bear with me here. I'm starting with the 10-year Treasury. But the 10-year Treasury right now is yielding 1.4%. That's 75% below the historical average. And why do we care? It's because this creates a very material income gap for pensions, endowments, and trusts. And that income gap is made up via the investment in growth equity. That's increased demand for the market. And secondly, when we look at valuations, unlike the market, which today is at all-time highs, valuations aren't. And now, admittedly, there are some individual securities and subsectors where this is not necessarily the case. But in particular, if you look at the Russell, we're trading just above the historical averages here in terms of valuation. This gives room for multiple expansion and can also continue to drive the market higher. If we look at the consumer still remains quite strong. And while we're starting to see some of the effects of inflation, in particular on rising fuel costs that you see highlighted there in the red square, the two most important drivers here, disposable consumer income and also consumer confidence, both are trending up and to the right, which is the way we want to see these charts working, and are approaching all-time highs. Likewise, on the corporate front, the cost of capital is currently at an all-time low. And despite these low rates, we've seen corporations delever their balance sheets, not only through the COVID-19 pandemic last year, but also year to date. Similarly, when you look at manufacturing capacity, its excess is available today. In the currency market, the dollar is still neutral to relatively strong versus most of the benchmark currencies. Your tagline from these four figures is simply this: corporate America emerged from the COVID-19 pandemic strong, leaner, more efficient, and more profitable. And in fact, if we look at corporate profitability today, it's now approaching an all-time high when expressed as a percentage of GDP. And here, mercifully, the macroeconomic talk stops, I promise. But if you look at the bottom two data points, these are the two key takeaways. We've returned, and that's worth repeating, we've returned to positive GDP growth. That's a good thing. And all of our major economic indicators are trending up and to the right. So how do we apply these macroeconomic statistics to what we're all doing here today in terms of funding innovation and growth? And let's start at the beginning and focus on the venture capital industry. And last year, in 2020, the industry raised a record $79.8 billion. And this year alone, we now have data through the second quarter, the industry has raised approximately $74.1 billion. So in the first 6 months of this calendar year, the venture capital industry has raised effectively the same record amount it did in 2020. Now, why do we care about that? Well, let's think back a little bit to Newton's second law of physics here to help us apply how we use this. And remember this is velocity equals mass times speed or acceleration. Let's change out velocity for value, and let's think about this statistic as the variable for mass. This is data from KPMG, and they've done a great job here, and I think it highlights the pull-through. Record amounts of capital going into the venture capital space at the start has generated a record number of transactions, and it's also increased the median size of the deal structure, not only for later stage transactions, which clearly have seen the most uptake here in value, but also in early and angel rounds as well. And what's near and dear to everyone in this room, appropriately denoted in the color gold there in the middle, is the number of up rounds has also increased. So what's the output from our equation? That was velocity, you had mass, this is value. And as I mentioned, we've now seen the second quarter data, and the venture capital industry for 4 consecutive quarters has posted venture exits valued in excess of $100 billion. Simply put, the markets like growth. This is a busy figure, and I apologize for that, but if you can take one thing away from these 4 figures, it's that there's an abundance of capital that has to be deployed in the venture capital industry today. On the left, you can see the number of transactions has increased significantly, both those that have been announced as well as those that have closed. But what you really need to take away from this slide is that currently today in the United States, there's approximately $700 billion in private equity capital, dry powder. And if we peel the onion a little bit deeper there and take a closer look at that stack on its maturities, what we really are confident about now is that the deployment of that capital means that you're going to see an acceleration not only in the number of transactions, but also in the size of related transactions. So if we pull this all the way forward to the healthcare marketplace, and specifically the public equity markets, your key takeaway here, or your tagline, is that healthcare remains at the forefront of value creation. And that's not too surprising. If you think about it, healthcare is 20% of the Russell. And when we think about growth right now, it's clearly the primary bias in the market, outperforming both value and income generating funds. And then similarly, when we look at fund flow data, which is varied a little bit here month to date in July, but there's an overwhelming bias for funding growth into the marketplace. This is good for healthcare because healthcare, as you all know, is known for innovation. We're going to see some very exciting companies later on this afternoon. We've got great panels here as well. And that correlates to what's happened in the market. So since the start of 2020, healthcare, broadly defined, has accounted for just a little over 50% of all IPOs and just under 50%, 48% specifically, of all follow-on transactions. And if we look at performance of those follow-on transactions, it's driven a 41% average return versus the market, so relative outperformance. And that's what drives the market's broad affinity for healthcare in general and what's contributed to the backlog of 41 IPOs here in the healthcare space as of the end of the month of June. By the way, that number has increased throughout the course of this month as well. This is just a quick slide to reiterate that same point, highlighting that the market's agnostic. It likes growth right now. That's the bias. And we're seeing a broad base here across the healthcare spectrum in terms of activity. So if we want to get into real kind of the nitty-gritty now, when we talk about the healthcare market in particular, and specifically healthcare IPOs, it's important to note that year-to-date, 14% of all healthcare IPOs have priced above the range. That's our goal, right? That's the target. 82% have actually priced within the range, but that doesn't tell the whole story because a number of these transactions have actually been upsized and we've seen their valuations recast before they actually went public. There's a very favorable dynamic right now in the public equity markets for healthcare IPOs. Additionally, what I would want to highlight here is that we come down a little bit further and we think about, well, what does the market really want? And if we started this discussion back at the start of 2020, I would have had to stand here today before you and tell you needed a clear line of sight into $100 million in a revenue run rate. But that changed with the COVID-19 pandemic. And we actually have seen a switch to early stage development companies as well as SPACs. In fact, the number of SPAC transactions increased fivefold in 2020 versus 2019, a total of 253 deals, $71 billion in value. So if we then think about, well, what's performed the best this year to date, candidly, it's been a little bit varied, and we're starting to see a pivot back towards more SMID and mid-cap growth, but still a bias towards emerging growth companies as well. And to define that, maybe put some parameters around that for you, we're generally seeing a bias for companies in that 50 million-ish range on the small cap side, and we've seen some private equity exits as well, closer to $2 billion in revenue, which have also been some of the top performers. Big disparity here, but the one central theme that ties these all together is growth. And the average growth outlook that we're looking at here is in the upper teens, generally 18 to 20%. We've seen great success with healthcare IPOs this year. Good example here within ophthalmology was Sight Sciences just last week, and congratulations to them. You had an upsized round and it delivered a 40% return in that very first day of trading. That's above the average of 20% right now. So how do you become that 14% player? You're pricing above the range, generating a 20+% growth rate. Well, it's a durable economic business model that has the potential for margin expansion longer term. Not to say that this is the zip code that you have to live in to be successful, but just trying to lay out a few of the points of what the market is most receptive to right now. Ophthalmology is clearly unique within all of healthcare. It's been a personal favorite of mine throughout my 25+ year career. And the real key that I want to highlight here is ophthalmology is known for its innovation. And when you look at this relative outperformance, it might be a little bit surprising to you. Clearly, some of the smaller cap names that you would expect have helped drive this relative outperformance. Companies like Star Surgical, Ocular Therapeutics, Iridex, and Glaukos. But it's also been very broad-based in the large cap bellwethers. And there you've seen companies like AbbVie, Alcon, and Carl Zeiss all deliver 30+% returns. So if we bring it all together here today, fortunately, the challenges that we face are not the same as what we saw at the start of 2020, but they're no less relevant and they're no less important. We've given you some macroeconomic data facts as well as some secular themes, and I'd really just want to re-highlight there's $75 billion approximately in the venture industry today that has to be deployed. just under $700 billion in the private equity markets. And on the public equity side, today, there is approximately $4.5 trillion parked in money market funds. That's down just slightly versus the all-time high of $4.7 trillion that we saw back in May. It's undeniable that the deployment of this capital, whether it be individually or collectively, will have a positive effect on valuations. So if we think about these data points, we think about the capital that has to be deployed, I hope you'll agree with me that we still have a very favorable outlook for funding growth and innovation. It's really all about perspective. And so on behalf of Stevens and myself, I'd just like to thank again the Eyecelerator panel, the AAO and the ASCRS for letting us be a part of this inaugural in-person meeting. It's a true honor, and I'm excited to see what innovation we have later this afternoon. Thank you for your time.
Nicely done. Let's give Chris a big round of applause. I've never seen Newton's Law. Newton's Law in the VC market. Wow. Wow, that's a new one for me.